the story of the first half of 2023 is ChatGPT. It's a big deal. As skeptical as I am and as concerned as I am about big technology, these large language models, the ability to essentially carry on a human-like conversation with a computer is a huge breakthrough. It's a huge change. I think it's been going on behind the scenes a lot longer than we realize.
Let's start, Richard, with the screen that we're looking at here. We're looking at the 5 big indexes here. We have the S&P 500, which is the second one on the list here. We've got the NASDAQ, which is leading the pack by more than multiple lengths if this was a horse race. And oddly enough, the blue chips, the Dow, 30 stocks that are not keeping up with everyone else, and the mid cap and Russell stocks in between. Did that sort of play out the way you thought it might based on what was driving the market in the first half of the year, Richard?
Look, the story of the first half of 2023 is ChatGPT. I didn't see that coming. I have some friends who were a little ahead of it, more ahead of it than me. It caught me by surprise. It's a big deal. As skeptical as I am and as concerned as I am about big technology, these large language models, the ability to essentially carry on a human-like conversation with a computer is a huge breakthrough. It's a huge change. I think it's been going on behind the scenes a lot longer than we realize. This idea of large models with many, a million variables and giant data centers. I think that's what institutions like Citadel Securities have been doing with payment for order flow data, et cetera. But yeah, the magnitude of the NASDAQ's rally certainly caught me off guard. We did have some bullishness in the cycles starting in November of last year that we called for an upswing, but didn't expect it to last all the way into July. So definitely wasn't expecting that magnitude, but all along I've said, we really don't know what's going to happen. And the biggest thing is minimizing your maximum regret, right? So yeah, keeping some powder dry for an opportunity, but also making sure you've got exposure so that if something does unfold, that, you're not kicking yourself for the rest of the year. So it's been a surprise. Yes. Certainly the magnitude of the NASDAQ's move. We've covered also that, most of this is in 7 stocks, which is crazy. The difference between the NASDAQ and the S&P 500 largely is due to 7 stocks that are all the big technology stocks. And the big technology companies getting more and more bigger and bigger slice of the equity pie is not something I'm comfortable with, and not something I think we should be really comfortable with as an economy and as a society.
I think that's right. And as things have exploded, like Nvidia's rise to the very top, near the very top of that of those big 7 or 8 stocks. And also you look at Apple becoming the first $1 trillion company for at least for a short while this week.
$3 trillion.
$3 trillion. For
right.
The first $3 trillion. Every time it's hit milestones like that before, it's been a time for a pause and reflect as opposed to a time for a jump in. Mm-hmm. So, and one of the things we want to talk about here is to be able to look at some of those trends, some of the things that have happened, and what we can do if we have that new money to put to work, or if we want to rotate out of some of those hottest, best performers, and you were lucky enough to be in those, to be able to rotate some of that money somewhere else. But I love your theme of maintaining some exposure as well, because I think you can't win the game if you're not playing in it. So I think that's a key thing, Richard. Let's look, before we take anything else, at how this breaks down from big indexes into individual sectors. So let's just take one quick look at that. And this shows us the return by sector. And I think these are just sector specific exchange traded funds. Mm-hmm. So we have up at the top technology, dropping down to communication services, mostly Google or Alphabet,
Hmm.
and Meta or Facebook. And then we have consumer discretionary, which has some of the big players like Netflix and Amazon stuck in there. Then sort of the real stuff, industrial materials, real estate, consumer staples almost flat for the year, Richard, and then underwater finance, the finance group, healthcare, energy, and utilities. What stands out to you here in this chart?
I'd be rotating out of technology and into energy utilities myself. I think that this technology rally has gone too far, too fast. I don't see the gains in, that I don't see AI delivering these gains to companies yet. And I'm continue to be skeptical, on my analysis, my cycles charts, the weekly S&P 500, um, let's say, didn't cross a major resistance line this week. We're correcting back. We could certainly see a little more rally, but there's definitely more reason, as I see it, to be cautious than bullish, especially on technology right now. So looking at this chart, I get interested in looking at financials, healthcare, energy, and utilities, and particularly things that are going to give me less risk, lower volatility for what I think could still be a significant down move before the end of the year.
Well, I think we did a fairly decent job of looking back in order to look forward there already. But let's talk about what's going to be happening in the second half of the year and maybe going forward. And one of the things that I think struck me very much is one of the strange seasonality patterns that we get. And I know some of your early work, and one of the first websites you put up was all about seasonality. And it's been one of the things that has informed my analysis for decades. And I think when we look at something like this chart that shows us how the different months act over the last 10 years, the last 20 years, and dating all the way back to 1950, gives me a little, hey, that's unusual frame of mind when I look at July. I'm going to put some marks around July here and how strong July has been dating back to, here is the numbers dating back for 10 years. Here's the last 20 years, and even dating all the way back, if we look back to 1950, July is a strong month standing out among May, June, August, and September, which are among the weakest months of the year, really the four weakest months of the year, except for February. So it's sort of a rose among the thorns, if you will. And I tend to think about that, Richard, as boy, it's not time to leap out of the boat today. Here we are in the first week of July because we have some tailwinds behind us. But that chart does tell me to, whoa, we got to look at the summer doldrums and being prepared for that. What are you seeing when you take a quick look at the seasonality here?
I love Seasonality. It was the first website I ever built, seasonaltrader.com. It's one of the most consistent and valuable things in markets, period. So that definitely gives me pause, that July bullish seasonal tailwinds about, a sharp correction here. That, we're in the middle of a little correction right now. How far that could persist, I think the July seasonal tailwinds could keep the bears away until August. So
That's I think that could very well happen. And 9 of the past 10 years, actually, the S&P's been up. 10 of the past 10 years, the QQQ's been up. So something just to keep in the back of our minds, if nothing else. But I know there's a bunch of other things you want to look at in going forward. But just as we wrap up going forward and what to do, to put that new money to work or to switch some money around. But I think that just wrapping up the first 6 months and the last couple of months of last year, thinking about what happened in AI, anything you would leave folks with thinking about going forward? Is this, I missed out on the AI crunch. What can I do? Can I jump back in now? What should I be doing? What would you be telling somebody that was asking you those sorts of questions, Richard?
Well, I came up with a new phrase over the past week, which is get your head out of your mass media.
I love
And
it.
I think that AI has become such a hyped story. Even just calling it AI, right? I mean, AI has been around for 60 years, okay? It's been through so many hype cycles and still it hasn't delivered. So yes, ChatGPT is novel, it's interesting, but for right now, it's about as it's got as much credibility as NFTs for me, you know. And everybody was excited about NFTs 2 years ago, and now who do you hear talking about NFTs?
Yeah.
So you've got to be skeptical about the gains that we've already seen from AI, the possibility of future gains. And I think that you've got to be looking where other people aren't, right? So one of the things I wrote about recently in my article, to Nvidia or not to Nvidia, is how these stories that take, just huge mental headspace, right? It's like all you could talk about for 2 weeks, all anybody could talk about was Nvidia. Meanwhile, there's 10 or 20,000 things you could invest in, that around in the United States, around the world, and just obsessing over Nvidia is disproportionate to the space, its opportunity space. Okay, so we have to be able to look not where the media is telling us to look, right? We have to get away from these stories that are capturing way too much attention and look in some other places, right? So that's a big part of why I've been building the tools that I have to help people, look off the beaten path. I mean, one of the big things, DR, 2-year treasuries just hit 5.1% today. Okay. For 2 years, you can earn over 5% on your money as of today, right? In the safest investment in the world. So that's a big deal, right? And you can get pretty safe money. You can get higher rates and still be pretty safe. So you've got to factor that into your portfolio. Yes, if you really believe in AI, you really believe in big tech, okay? Not my cup of tea, but hey, other people have different ideas. But let's look at how you could combine that with, say, 2-year treasuries now to reduce your volatility and give yourself, a lot more cushion on the downside if things do fall off their perch. So if we have a few minutes left, I can show a little bit of that in Finiac. I can go ahead and share my screen, some things I've been thinking about. Here we are looking at a portfolio that's just QQQ, okay? The volatility, 2.2%, meaning that, you should expect at least a couple times a month to have a day where your portfolio moves at least a couple percent, 2.2%. And you can see that in the histogram here. It's up, it's down more than 2% regularly, and it's up more than 2% regularly. And so this is a pretty volatile asset. Meanwhile, if we look at, I think it's SHY combining with SHY, these are the short-term treasuries, right? Not volatile at all. So let's add that to the QQQ portfolio together. And it cuts the volatility in half, down below, 1.1% now. So that's a lot less volatility. And you're getting some diversification here. And you've really tightened up your histogram so you're not having those wild days, right? We were looking at utilities. I think they were at the bottom of the sector chart, right? The worst performers. Let's try adding those to this portfolio here. Whoa, our diversification score just jumped up to almost 36%. So that means that we're getting, these aren't all going up and down together at the same time. They're going up and down at different times. Add a little more volatility back into our portfolio. But hey, now we're still exposed to AI, and this is just an equal weighted portfolio, 1/3 in each of these. We've still got exposure to technology if it continues to, basically take over the world, right? I mean, these 7 companies are practically like nation states now. But we've also got some cushion for, 5+% a year from treasuries for the next couple of years. And we've got, a sector that has some catching up to do in utilities. So these are the kinds of portfolios that people can build. This is the way that people should be thinking, not just about to Nvidia or not to Nvidia, right? To Apple or not to Apple. No, we've got to be thinking in terms of what's our risk tolerance? How do we put things together that give us diversification? And how do we make sure that, we can maintain our exposure in the markets in a way that we're comfortable with, that's not going to be getting inside of our head and getting us to be reactive instead of proactive. So, as I said, get your head out of the mass media. And that's my theme for the second half of 23. Overall, the cycles, the weekly cycles are up for the next 12 to 18 months. I still think we've got a little more pain ahead. I'm not jumping in with both feet at these prices, especially into technology. And I don't think anybody else should either.